Welcome to the Pro Ticker Deep Dive. So if your picture of the financial system is still, just the big regulated banks, the ones we all know, you're working with a really outdated map.
That is a perfect way to put it. We're seeing this fundamental shift in global finance.
A huge one. And it's toward this quiet $75 trillion giant that is completely reshaping how money moves around the planet.
Right. And our mission today is to get into what our sources are calling the shadow banking comeback. We're going to give you the background to understand, where this enormous pool of money is actually going.
And why this whole ecosystem matters, even if you're not directly in it.
Exactly. And the risks you need to watch.
The scale is just, it's hard to get your head around. When we say shadow banking, we're talking about a collective term, right?
Yeah, it's everything from hedge funds and private equity to money market funds and those newer P2P lenders.
And the valuation is somewhere between, 75 and maybe $95 trillion globally?
That's the range, yeah. It really depends on how you define the scope. But it's the trajectory. That's the key thing here.
The growth.
The growth. It's projected to hit maybe 150 trillion by 2030. That's a growth rate of, let's say, 6 to 9% a year.
Which is way faster than traditional banking.
Massively outpacing it. And that proves the point.
Mm-hmm.
This isn't some temporary thing. It has evolved, it's gotten more professional, and it's become this resilient, parallel financial system.
Okay, let's unpack that. I mean, we're talking about this spectacular growth happening after 2008. What created the perfect storm for this comeback?
It really starts with what you could call structural arbitrage. After the 2008 crisis, regulators unleashed what the sources call a blizzard of new rules.
Basel III, all that stuff.
Exactly. Basel III, much stricter liquidity standards, stress testing for the big banks. The goal was to make them safer.
And it worked, right? They are safer.
They are, absolutely. But that safety came with a huge cost. Those rules basically constrained the bank's ability to lend aggressively.
And to take on risk.
Crucially, to take on the kinds of risks that generate higher returns. Certainly, a bank has to hold way more capital against a risky loan, which makes that loan less profitable for them.
So the banks got slower, more expensive, but all that capital out there still needed a return.
Precisely. And the shadow banks stepped right into that gap. They operate outside of that traditional oversight.
So no deposit insurance, none of that.
None of it. Which means they don't have the same burdensome compliance costs or those mandatory loan loss provisions. This lets them use more leverage, take on the riskier assets, and just move at a speed the regulated system can't touch.
That explains the opening. But money doesn't just flow on its own. Why were the big institutional players so desperate to chase this kind of risk?
It's that insatiable appetite for yield. I mean, think about pension funds, insurance companies, endowments. They have these huge long-term obligations they have to meet. If government bonds are giving you 4 or 5%, and inflation is a factor, an alternative strategy promising 8, 10, or 12%, it's not just attractive. It becomes absolutely necessary.
They're forced to hunt for yield.
They are. And the shadow banks are right there, ready to provide it.
And the whole machine is lubricated by technology. That scale wouldn't be possible without it.
Oh, it's the engine. Fintech companies built these amazing algorithms to assess creditworthiness, way faster than a traditional bank. And P2P platforms just bypass the old intermediaries altogether.
Which lowers costs and lets it scale globally.
And we can't talk about global scale without talking about China. That's where this thing just went parabolic.
Right.
The growth there was explosive. Their system has things like trust companies and entrusted loans, which are basically ways to channel money around official lending restrictions.
And the numbers are just staggering.
They are. We're talking 8 trillion yuan by 2021. In some parts of their market, you saw annual growth over 20%. That volume creates systemic risk for everyone.
Okay, so now that we get the why, let's follow the money. Where is this capital and risk actually piling up? The sources say global non-bank assets are around 250 trillion.
Which is almost half. Something like 49% of all global financial assets. It's huge.
So where do we start?
Let's start with broker-dealers. They're the biggest segment, projected to hit 55 billion by 2030. They're essential for market making, making sure you can buy and sell things like treasuries smoothly.
But their risk is liquidity, right? How does that work?
It's all about leverage and short-term funding, especially the repo market. They use overnight loans to fund massive inventories of assets. If that repo market suddenly freezes,
Which it did in 2020.
exactly, the 2020 Treasury market dysfunction, they're forced to fire sell those high-quality assets, which makes the crisis even worse.
Yeah.
It took central bank intervention to stop a meltdown.
Then you have the poster child for leverage, hedge funds. They're managing over $4 trillion now.
And again, it's not just the assets, it's the leverage. It's not uncommon to see strategies using 50 to 100 times their net asset value.
100 times.
Take the basis trade. It's a hugely popular strategy. You short a cash treasury bond and go long the futures contract.
Why do you need so much leverage for that?
Because the profit margin is tiny, just a few basis points. So to make any real money, you have to do it at an immense scale with borrowed cash. Our sources estimate that one trade has about $800 billion of notional exposure.
Which means a small, unexpected move in interest rates could just vaporize it.
Instantly, with massive ripple effects.
Okay, that's the trading world. What about the private markets? Private equity firms are sitting on over $2 trillion in dry powder.
Right, and PE uses companies themselves as leverage. When they buy a company, they're often using debt that's 5 to 8 times that company's annual earnings.
So the risk there isn't a flash crash.
No, it's more of a slow burn. When interest rates go up, the cost to service all that debt skyrockets. It puts huge pressure on their companies, and since it's all happening outside of bank oversight, the distress can spread quietly through the real economy.
And then for just pure blistering growth, fintech and P2P lending.
This is where the acceleration is, over $1 trillion in global loans. Some markets are seeing 25% growth a year. It's filling a real gap for small businesses and consumers that banks left behind.
But the risk.
The speed. The lack of those traditional loan loss buffers means when the credit cycle turns, the losses can pile up incredibly fast without the usual safety nets.
And we can't forget money market funds.
No, they're essential for corporate cash, but they're so vulnerable to runs. We saw in the 2023 banking turmoil, when stress hits, money flees, and they have to be bailed out to stabilize the system. It shows how fast confidence can evaporate.
So on one hand, it's a system offering better returns, faster service, and filling real credit gaps. Let's look at the bullish case before we get back to the red flags. What's the opportunity?
Well, the yield is paramount. Alternatives can structurally offer those 8 to 12% returns that public markets just can't match right now. For a lot of big funds, it's not a choice, it's a necessity.
And they are filling a genuine credit void.
Absolutely. The big banks have pulled back from things like leveraged buyouts or subprime auto lending. The shadow banks are scooping that business up, and in doing so, they're funding parts of the economy that would otherwise be starved for capital.
There are demographic tailwinds, too.
Big ones. Millennials and Gen Z just prefer digital-first services. They are not attached to the old branch banking model. And that means more and more capital is naturally flowing away from traditional banks and toward these agile digital providers.
It sounds incredibly efficient. But we know every bit of that opportunity comes with, well, often magnified risk. What's the number one red flag?
It has to be leverage. The primary system-critical risk is leverage. You just have to do the math. When you're using 50 or 100 times leverage, a market move of just 2% against you, your fund is gone. It just implodes.
And that triggers margin calls that force you to sell everything.
Exactly. And the textbook example of that, the one everyone needs to understand, is the Archegos collapse in 2021.
Right. A $10 billion fund that almost took down the system.
It was a family office, supposedly small, but they used derivatives, these total return swaps, to build up these enormous hidden positions in stocks. We're talking 50 to 100 billion in exposure.
And the key word there is hidden.
Completely. The big banks financing them, their prime brokers, had no idea how much leverage Archegos had with all the other banks. So when they got hit with a margin call,
the whole house of cards came down.
And the banks that financed them were left holding the bag for billions in losses. It almost took down several globally regulated institutions. It showed how a small, shadowy player can threaten the whole system.
So extreme leverage is one problem. The other is the liquidity mismatch.
Correct. Shadow banks are borrowing short-term overnight, essentially, but they're investing that cash in long-term illiquid assets, private credit, structured products, things you can't sell in a day.
So when the market gets shaky, everyone wants their money back at once.
But the assets can't be sold. So you get these fire sales that cascade, which we saw in that 2020 Treasury event. It just feeds on itself.
And how quickly does that fire spread back to the safe, regulated system?
Almost instantly. The systems are deeply interconnected. Traditional banks have massive exposure through prime brokerage, repo lending. derivatives. The sources show over $1.2 trillion in direct bank lending to the shadow sector,
So a big failure there is a direct hit to the regulated banks.
a direct and very damaging hit.
Okay. Given these risks are so clear, regulation has to be coming. What are we seeing from policymakers?
Oh, it's definitely underway. You're hearing explicit calls from people like ECB President Christine Lagarde for tighter scrutiny.
Hmm.
The Financial Stability Board, the FSB, is proposing actual leverage caps on hedge funds.
And what about in the U.S.?
The SEC is moving to regulate private equity more strictly.
Hmm.
They're focused on making fees more transparent and bringing some of those opaque practices into the light.
So this pressure is building.
It is. And it will almost certainly squeeze profitability in the sector and change the competitive landscape over the next few years.
So if you're an investor trying to read the tea leaves on this system, what are the technical signals you should be watching?
Well, first is just institutional allocation. That shift from 15% a decade ago to over 30% today, that confirms the trend. But you have to watch volatility,
The VIX.
the VIX index. When that fear gauge spikes, leverage gets really expensive fast. That forces margin calls and selling. We've seen that happen twice this year already.
What about more specific credit indicators?
I'd watch three. First, the Bloomberg Leveraged Loan Index. That tells you the health of the highly indebted companies that shadow banks finance. Second is the TLT, the 20-plus year Treasury ETF.
Why that one?
It's a proxy for duration risk. If TLT plunges because rates are rising, all those highly leveraged long-duration trades get crushed.
And the last one. Yeah, IC BOFA OAS. That sounds a bit technical.
It's the option-adjusted spread. It's basically a measure of how much extra compensation investors demand to hold risky corporate debt versus safe government bonds.
So when it widens.
When it widens out dramatically, it means the market is smelling trouble. When those three indicators hit extremes, it's a signal that the system is under stress and a period of real caution is warranted.
So let's bring this all together. What does this mean for you? The sources paint this really clear picture. Shadow banking it's a permanent, essential feature of modern capitalism now.
And it's going to keep expanding, likely at that 6 to 9% annual clip. It's driven by innovation and that institutional need for yield. The real question for the next decade is whether regulation can evolve fast enough to manage the risks without just crushing the efficiency the system brings.
And finally, our sources point to China as the great wild card here. We've seen that more regulation can slam the brakes on their shadow banking growth, while deregulation just hits the accelerator.
It's a huge variable.
So with China's economy going through its own massive structural changes, how will that tension between their domestic policy and this global desperate search for yield play out in this $75 trillion plus sector over the next 5 years? That's really the ultimate challenge.
Think about that connection, local policy decisions dictating global stability.
See you all in the next Pro Ticker Deep Dive.